All right, let's connect with Dipan Mehta, who's joining in, Director Elixir Equities, to get in his take on the markets. And Dipan, what do you make of the fact that despite the fact that we're near all-time highs for the index, a lot of the heavyweights haven't really made their presence felt? Reliance Industries, HDFC Bank, ICICI Bank, from the 1st of December, these stocks have either been down or completely flat.
Yeah, good morning, and thank you for having me on your show. This is a mid-cap market, actually, and I have no problems with it because, actually speaking, portfolios are doing exceedingly well. Sometimes we see optically the index keeps on moving up. It's on the strength of two or three large index companies, which one may or may not have in their portfolio, that do not at the proportion or weightage which is there in the Sensex and Nifty. But by and large, I think a lot of these side counters are doing exceptionally well. The number of stocks hitting new highs also is moving up. The advanced decline ratios the last few weeks have been also very positive. So I think it's only a matter of time before the Sensex Nifty also start to scale higher and reach new highs. I suspect that a lot of investors' portfolios are anyway trading at new highs. And that's a very positive phenomena and does give more confidence to invest into equities and perhaps commit even a higher exposure from the savings pool.
Where is it that you're confident about when it comes to the mid-cap universe? Because we were mapping out the data, and in terms of what really has led the markets higher include a lot of the mid-cap names, the likes of Polycab, Aurobindo Pharma, Paytm, Persistent Systems. What is your take as to where to deploy funds within mid-caps currently?
See, I think one strategy which has worked very well is that in any sector which you are positive on, if you go down the line, look at the tier 3, tier 4, or tier 3 or tier 2 companies, or the mid-cap companies within that particular sector, then you will find that in bullish markets like this, those companies will tend to outperform the market leaders or the large cap companies within that sector. So for example, if you like the NBFC space, then companies like Cholamandalam, MFI companies like Spandana, or Credit Access, Poonawalla Finance, I think Awas Finance, these are the companies which will tend to outperform the larger ones, like say a Bajaj Finance or a HDFC for that matter. And similarly, down the line, when you go to banks, I think smaller banks like IDFC First Bank, AU Small Finance Bank, to an extent Federal Bank, and even IndusInd Bank, they may outperform the ICICI Axis and Kotak HDFC banks. And that particular investment theme is true across many sectors. You can play it out. You can see it being played out in software, in pharmaceuticals, as well as in capital goods and engineering companies as well. So, I mean, there are many sectors which are in sort of a blue sky scenario, looking at good earning visibility. But within those sectors, if you go for mid-cap stocks, you can have them outperforming the index and the large cap peer group companies.
The Nifty IT performance has been month to date, and in the meantime, of course, you're having a whole host of these analyst meets as well, and TCS's annual report just came by yesterday, wherein N. Chandra as well as the CEO of TCS have highlighted the focus on digital new technologies like AI. Just yesterday you had Infi's annual report as well, wherein the number of times AI was used was actually 56 and number of times artificial intelligence was used was 4. So all in all, that's a heavy duty 60 count, at least from the Infosys annual report takeaways. But Dipan, clearly seems that Indian IT as well is advancing and understanding the need for AI and the need for that progression. But you think these stocks become a good buy now?
See, I think that whether AI is going to provide the same kind of wave as, say, Y2K and internet and digitalization, cloud computing, there were so many waves in the IT industry because of which we saw great wealth creation over the past almost 2.5 decades or so. And whether AI is a similar opportunity, it's a bit early to say so, at least from a non-industry perspective. But yes, I think it's certainly a growth opportunity and it may lead to higher IT spends. But the problem with large cap Indian ITs is the size. And unless they don't get, $200-300 million type of contracts, it doesn't really move the needle that much. So I would be a bit more selective in IT, go for smaller companies. In any case, I think mid-cap companies have really established themselves. They've created their niche. large Fortune 500 companies also realize the value they bring to the table. And some of the companies which are focused on very specific verticals where there is limited scope or little scope of IT spending cuts, I think that's the ones we should focus on. Disclosure, I mean, companies like Tata Elixir, KPIT Cummins, Persistent Systems, to an extent, even Coforge, I think, they are all focused on very specific verticals where I feel that the risk of slowdown in spending is little less compared to the large BFSI players or those focused on retail or insurance for that matter.
Let's just bring up Nykaa as well after the Morgan Stanley note, which has come out post their, analyst meet. And you've got Morgan Stanley now maintaining their overweight with a target of 188 on Nykaa. They're saying that they see faster growth in the beauty and personal care segment versus e-commerce, and saying that the company plans to add 50 new stores in FY24. The gross margins in fashion actually could be higher than beauty personal care segment, and the margin drivers from here on, according to them, are going to be lower expenses and rising ad income. Attrition also, they said, was normal in the business scenario, and the churn rates are lower than that of the rest of the industry. And, that's why they're having this overweight call with a target price of 188 on Nykaa. But Dipan, I think out of all the new age tech businesses, Nykaa, I think, has been the slowest to recover, perhaps, from its 52-week close or the recent correction which transpired. What's your call on the stock?
See, we have invested in Nykaa at the time of IPO, and clearly we are seeing kind of a correction, and it has certainly not done well for us and many other investors. Maybe it's a mismatch in understanding, over expectation. I don't know the real reasons, but as we are discovering this company more and more, we do feel that that's got far more challenges than before. The competitive intensity certainly has increased, although Nykaa does have certain strong moats to protect its business. But it's not, it's going to be difficult for the management to really scale up as we thought earlier, as well as to come to solid profitability. And I feel that other comparable businesses or other platform companies like, say, Zomato or Paytm have made far greater progress in terms of their road to profitability. And I would even like to consider Policy Bazaar. I think they're also, they are making good progress to come to profitability. But when it comes to Nykaa, because of the business that it is in and because of the competitive intensity, I'm just a bit skeptical. And these companies now, there are so many choices elsewhere in brick and mortar which are available at reasonable valuations. And I feel that there is greater scope of outperformance in those businesses than in Nykaa at this point of time.
But curious, Dipan, to get in your take, and if we were to discuss IndusInd Bank and, talk about the triggers and the kind of commentary that the bank management as well has given, why do you believe maybe that its outperformance recently has gone unnoticed?
So I think some of the sheen of IndusInd Bank certainly has got wiped out, the way they handled the post-ILFS crisis and the way the NPAs moved up. And after having studied the company for more than a decade, I've come to realize that the company has got a lot of exposure. The bank has got exposure to some of the riskier, I would say, segments in the banking industry. They have a large MFI portfolio. They lend to the vehicle financing as well. And there's the jewelry lending business to the diamond industry. Now, all these businesses tend to do well when the entire economy, the sector is doing well. But when things go sour, that's when the NPAs try to climb up in these three particular segments. So in a way, IndusInd is a kind of a slightly more higher risk, high return profile. And right now, I think banks are going through a kind of a blue sky scenario, which is why I think IndusInd Bank's next 2-3 quarters will be exceptionally good. Their credit costs will remain low, and the demand is good from the segments to which they are lending to. I think also there's a scope for a marginal improvement in the price to earning, price to book ratio as well. It's trading at a steep discount to some of the larger peer group bank companies. So keeping all of that in mind, I think we could have a medium term or a short term trading rally in IndusInd Bank. But this is not the company you want to hold for many, many years, especially when the banking industry is going through a down cycle. It cannot be part of your core holdings like, say, HDFC Bank or ICICI Bank or Axis for that matter. and you need to have a little bit more, watchful eye on how the NPAs are moving up quarter after quarter.
I'm just scanning through the insurance sector, and the growth for the general insurance industry is actually not bad. 16%, 18% year on year. LIC is losing market share. ICICI Lombard is gaining market share. Star Health is gaining market share. Dipan, COVID has taught us the importance of safety. You buy term insurance because you want to protect your near and dear ones. You want to buy health insurance because you want to you want to ensure that if there are some medical needs, they are taken care of. Now that's a long-term, multi-year trend, and COVID has only accelerated the adoption of this trend. Yet if I look at insurance stocks, I mean, they have been the biggest underperformers in everyone's portfolio. I mean, like your eyes are popping out right now, Dipan, my eyes also pop out when I look at the underperformance in insurance.
Yeah, Nikunj, good morning. But it's, I think, partly to do with what happened in the last budget as well. And, slowly and steadily, I think the regulator and the government feels that the kind of a tax arbitrage or the interest portion arbitrage between mutual fund banks and insurance should try and get bridged. So from that point of view, insurance products will get slightly unattractive. But you're right. I think the runway for growth is phenomenal for these companies. And if they get the formula right, if they have got good tie-ups, if they've got a good marketing strategy in place, if they've adopted technology, then I think these companies can scale up reasonably well. One should always keep in mind that a business like insurance is a great secular business. I think year after year after year, you will keep on getting that enterprise value moving up by, for the private sector companies, in that 15 to 25% range. Something like LIC, I'm pretty confident they can do a low double-digit type of improvement in their enterprise value. And I think that should keep investors interested. I wouldn't want to be completely out of the insurance sector or be terribly underweight as well, because this sector does tend to come around quite quickly, especially when the markets go through a bearish phase. And you're right. I think the non life insurance business that should scale up well. The likes of ICICI Lombard or Star Insurance, I think after a few quarters of tepid performance, I would expect that with the economy moving up and COVID out of the way, number of new vehicle sales also increasing significantly, I would say that the next prospects for the non-life, the general insurance companies, next 2-3 quarters looks quite interesting.
What are you doing at 6 p.m. today?
Sorry, I didn't get the
What
question.
What are your day plans at 6 p.m. today? What are you planning to do? What is there in your calendar?
Well, I think no real plans, Nikunj. We could catch up for a drink.
No.
Yeah.
Well, you should watch ET now. And the reason why you should watch ET now is because Satyan Gajwani is going to be in conversation with Sam Altman, and he's the man of the moment. He's considered, you want to understand anything about rebooting and how AI revolution would actually change the world? Well, that's the man, and that's the guy you really want to hear. So, Dipan, I think the drink will have to wait. Now I've told you what is coming at 6 p.m. on ET Now today.
Forward to it. I think it's a very interesting conversation. And I'm also every day reading more and more about this chat GPT and artificial intelligence. And certainly we want to try and use in our day-to-day lives.
Nikunj, have all your latest emails been written by ChatGPT, or is it you
I've
personally?
Tried it, I've tried it, Avan, and I'm trying to learn right now. And this is something which I really want to implement going forward. It is pure efficiency and productivity, Avan. Instead of writing 3 emails a day, imagine if I'm able to, communicate with 5 emails, or if I'm just sending 2 emails a day, ChatGPT, can it really make it, can it increase to my productivity, and can it save time? The answer to that is absolutely yes. I mean, you have to understand technology, you have to adopt technology. If you don't do it, then trust me, your competitive advantage in today's tech-dominated world, I think, is only going to, nullify. And, I happen to read a very nice, I happened to see interaction of N. Chandra on one of the media networks, and he said, something very brilliant. He says that in today's disruptive world, you really have to be ready to what's going to hit you next. And he says that if you do not adapt technology, the technology adaptation will ensure that your job is not going to be there. I mean, that is something which is absolutely clear and absolutely real. So Dipan, I'm just trying to put a very big picture argument here. In India, how can an Indian investor participate in this entire AI gold rush? Globally, there is Nvidia. That's almost become a $1 trillion company. But in India, for those who are watching the show, they are convinced that chat GDP and AI is the future. And what is the future? Well, that's and as a stock market investor, you need to invest in the future. How can an Indian investor invest in India and maximize on this entire AI adaptation?
So I think if you take a slightly longer term view, a good bet, of course, is the Indian IT industry. Right now, we do not know what proportion of revenues of these Indian IT companies is coming from AI and similar products. But there was a time few years ago that Indian IT companies started reporting their proportion of the revenues from the digital business. I do feel that over the next 2-3 quarters, maybe 1 year, the Indian IT industries or the IT companies will start reporting the proportion of revenues they are getting from projects from AI and related technologies. And that will give you instant comparison between which are the companies which are getting a higher and higher proportion of their revenues from AI and similar products and projects. And I think that will give you an idea or inkling as to who the winners are going to be in this space. So maybe a bit early right now to figure out how to play this particular investment theme or who are going to be the real beneficiaries. But I'm pretty sure 2-3 quarters down the line, we will have some idea as to how this entire AI magic is working on Indian IT companies. But I do feel that a lot of the opportunity will get captured by mid-cap IT companies as well. I'm really positive over there. I know valuations are on the higher side, but there's a new energy in a lot of these mid-cap IT companies. And look at the way some of them are hitting new highs, companies like Cient. I mean, we hadn't, it was underperforming for such a long time, and now it's catching up the way it has. So these are highly entrepreneurial driven companies, and smaller projects, smaller acquisitions also can make a big difference to their top line, bottom line.
Seconds to go for the pre-open session. And well, at ET Now, we are in a sense just seeding a thought that ET Now is all about rising with India. If India will rise, it has to be, if India will rise, earnings will pick up. If earnings will rise, stock markets will rise. So it's a matter of time that perhaps Sensex will hit 1 lakh. And mathematically, if you look at Sensex hitting 1 lakh, it should happen in 4 to 5 years. Why it should happen in 4 to 5 years? Because if the normal and the historical rate of compounding continues for equity as an asset class, given that we are in for double-digit earnings growth for next 3 to 5 years, it's a matter of 3, 4, 5 years that Sensex will hit 1 lakh. And the ring of 1 lakh on the Sensex is such a nice rate. So, Dipan Mehta, how soon do you think, when do you think we will hear that ring of 1 lakh on the Sensex? 3 years, 4 years, or 5 years?
I would bet on 3 years, Nikunj, or even earlier for that matter. I think the way this entire rally is shaping up.
You're the most bullish guy. Everybody have asked this question. They've said 4 years, 5 years, and 6 years. 3 years. Well, you're making somebody's morning really bright and chirpy by saying 3 years, Dipan. Okay, why 3 years?
See, I think, markets and index don't move in a linear fashion. And every time a bull market starts, it does get exaggerated on the upside, and same is true with bear markets as well. I think the way earnings are shaping up, the way Indian economy is shaping up, I think on all parameters, we are making great progress. The FII flows certainly have turned positive, and I expect them to be even more and more on the positive side as we see this build-up of a risk on trade. The global threats, be it geopolitical or be it inflation, interest rates, I think all of those have subsided. And we are entering into a nice zone when it comes to global financial markets. And I think whenever global financial markets are in reasonably good health, India does tend to get a higher proportion of inflows. And that certainly will drive stock prices higher over here. That coupled with a very solid, I think, earnings momentum for next 2-3 years, a lot of domestic liquidity also coming in, and with election year coming in, you can expect a great deal of government spending also to pick up. So I'm seeing that a lot of the kind of ingredients for a great rally over the next year and a half or so are in place. And it's not unlikely or unexpectable or beyond the scope of possibility that you could easily have a 25-30% compounding return in the Sensex for the next 2-3 years or so. It's happened in the past and certainly possible going ahead as well. But I think more than Sensex at 1 lakh, you will see a fantastic rally in mid-cap stocks. And this is a great time for investors to have a nice portfolio which can create a lot of wealth for themselves.
Dipan, good to have you on board. Thanks much for joining in and sharing with us your outlook on the markets.